George, you just did a video on how the second phase of the commercial real estate crash might have just started and how it's spreading into the banking system. What just happened?
Well, the rate of fraud that we saw back in 2008, 2009, back then we called them liar loans. I'm sure you remember that, Kenny. Your audience remembers that. We're seeing the exact same thing play out right now in commercial real estate. So what's happening, or what has happened, is in the huge boom in 2021, 2022, you had all of these investors go to the banks, and they're basically making up numbers as far as their positive cash flow. And so they just cooked the books. They just stated income, I think is what it was called in the residential side back in 2008, if I'm not mistaken. And so the banks, because they get caught up in this emotional frenzy that everyone's getting rich and they get FOMO like everyone else, they have an investor come to them with a property that they want to finance that's, let's just say, in reality, throwing off $100,000 a year in positive cash flow. But what they'll do is they'll just go to the bank and say, well, it's actually 300,000. And the banks will be like, yeah, okay, whatever. You don't even have to, we don't need to verify that. We don't need to see bank statements, and we'll just give you a loan based on the 300,000, and they can take that money, do other things with it. Or what we saw a lot is on the sell side, the sellers would bump the numbers, or basically fudge the numbers as far as the positive cash flow to up the price of the property. So let's just say the property is valued at, or would be valued at $1 million because it has $100,000 a year come to the bottom line. What they'll do is they'll say, oh, it's actually, 300,000. And now all of a sudden the price goes to 3 or 4 million, whatever it is. And they go to the bank, and the bank believes them because they've got the FOMO, and the buyers, they have FOMO as well. And so they're just not even checking the returns. They're not checking with the rent rolls. They're not talking to the individual renters. They're just taking it at face value because there's so much competition for deals out there. And then when they actually get the property, they find out, oh, it's actually not making $300,000 a year. It's making 100. And based on this, I cannot cover my mortgage payment. So it's both of those problems that are pretty much the same thing. It goes back to the liar loans. But where it's really, really going to impact banks is when these people can't pay off their loans because the cash flow wasn't what they thought it was, and therefore it blows a hole in the bank's balance sheet, and then they lend less, and that's when you have a negative impact on the overall economy. And that's not to mention what the increased risk within the banking system, which is just simply a network of bank balance sheets. It's not to mention what that increased risk does to future lending and future risk taking by those banks, which it becomes a feedback loop to the point where now it's even harder for those investors to get loans, those bridge loans or whatever it is they need to finance the next project. They start laying people off. That impacts aggregate demand in the U.S. economy. It brings it down, and that's drives further unemployment, and you just go into this cycle. So that's just one of the problems that we're seeing right now in the commercial banking system. And I'm sure we'll go into many more.
Yeah. And well, I always say, you got to trust but verify, because, the whole system is based on commissions. So the brokers that are actually representing the sellers, they're trying to sell it for as much as they can. And then the buyer, of course, which is called due diligence, has to dig in, verify those numbers. But they're also, as you know, trying to get the most loan that they can. And then the people that are actually given the loans are also commission based. They're so you got the sellers, the brokers also that are commissioned. You got the loan originators are commissioned. So the whole process of commission, and really the sellers trying to also sell it for the highest amount, and the buyers trying to buy it for the least amount. But at the same token, in some cases, they're incentivized as well.
Yeah, let's dive into that, because I think that's important for your viewers, Kenny, because the checks and balances there should be the buyer.
Correct.
To your point. They're the one, if the seller is lying about the numbers to juice the numbers, get a higher price, it's up to the buyer to do that due diligence. But what has happened, and you can verify this because this is your business. You're neck deep in this every single day. If you've got investor money, they expect you to deploy that money. You can't just sit there and say, hey, pay me 2 and 10 or 2 and 20, excuse me, just to go into T-bills, right, or just to keep the money in the savings account just because I can't find any deals. No. The investors are giving you their money so you can deploy that money and get the type of return that you promised them to begin with. So this is the position of the buyer, to where a lot of times they aren't incentivized to go ahead and be that check and balance, because they just have to put the money to work. And if there's no deals out there, this is the only one, then even if they know they're being lied to, hey, it's other people's money. And if they're, let's say, less than ethical, they're just going to go ahead and roll the dice.
That's right. Yeah. So right. The entire system is set up almost on a commission basis, right? We're talking about the buyer, the seller, the lender, and everybody. And there's supposed to be a solid process of due diligence between all of them, right? And one of the things that we're starting to see more of now is what's called, DSC, or debt service coverages. Those are starting to pop up. And what that really means is that's the lender's way of deciding how much loan that should be on a property. So the debt service coverage. So if there's let's say if you got income minus expenses, and that's your net operating income, the debt service coverage is the mechanism that tells the lender how much they can lend. So those debt service coverages are starting to show up now. So people are realizing that none of them are hitting their debt service coverage covenants. And so now the lenders are starting to step in and take a look at that per what you were saying.
And that's when they're seeing how much fraud was actually going on right under their nose. It's the whole Warren Buffett saying, when the tide goes out, you see he's been swimming naked. And we see this in every single cycle. And the point is, we're starting to see it now once again.
Yeah. And so what happens is, obviously, the buyer's trying to get as much loan as they can. The seller's trying to sell it for as much as they can. And at the end of the day, one of the things that we have to address is the interest rates went up a lot. So interest rates went up. And if people didn't have fixed rate debt, let's say, then now they're subject to those higher loan costs, those higher mortgage payments, and they've run out of cash. And so when you start to run out of cash, you start to default, you start to raise money from your other limited partners or your other investors, and you start to dilute the whole thing. And now that's when the lenders are looking under the hood now, and they're going, okay. And that's when the fraud's starting to show up, which was in that Wall Street Journal article that you highlighted.
Yeah, that's basically the tide going out, is what you just described, like a step-by-step process.
Yes, that's exactly
yeah.
Right.
Unfortunately, though, Kenny, it's not just the credit risk for the bank, which is extremely high. They're also having a lot of problems with their funding costs. So what that is, if you think about a bank's balance sheet, you've got assets and you've got liabilities. And we all know the bank's business model, most of them, is to lend long-term, borrow short-term. So since they're borrowing short-term, hopefully they can borrow at a lower interest rate, and they lend long-term at a higher interest rate, and they go ahead and pocket the spread. So what happened back in 2021, a lot of these banks bought U.S. Treasuries at, let's just say, 3%. And they put that into a category of the balance sheet, the asset side of the balance sheet, called hold to maturity. And so the daily swings in price really doesn't impact that. And it shouldn't impact it, other than if you get into a position where you have to sell those treasuries. So they're no longer unrealized losses. They turn into realized losses. If you could just hold those treasuries to maturity, you don't really have a problem, because there's no loss of principal there. But what happened in the case of Silicon Valley Bank, as we all know, is they started to see those deposits go to other banks. And in the settlement process with those other banks, they were forced to sell those treasuries to come up with the cash to settle, because they're transferring a liability. They've also got to transfer some form of asset. So that's when Silicon Valley Bank goes bust. But that's not the only problem you have as far as funding costs on the liability, because that's you're funding those deposits. But what we can see are the deposit interest rates that the banks have to pay. We see those interest rates going up as well. And if those interest rates are going up, now all of a sudden, and we see this in Japan with Norin Chukin Bank recently. They were in the news a couple weeks ago. And the problem there was the interest they were paying on their borrowing costs, so the liability side of their balance sheet, was going up and up and up because they keep having to roll over this debt short term as interest rates are increasing. But the asset side of their balance sheet is still paying them, let's say, 3%. So that model works as long as the liability side of your balance sheet, you're paying 1%. But even if you don't have any deposit flight, like we saw with Silicon Valley Bank, if your funding cost, that liability side, goes from 1 to 2 to 3 to 4 to 5%, now all of a sudden you're paying out 5% and you're only receiving 3%. Well, we know that that dog don't hunt. So it puts you in that exact same position where you're forced to sell all of those 3% assets, whether you like it or not, because you've got to buy an asset that's going to have a higher yield than the liability side, than where you're borrowing. So this puts them in a very precarious position where short term, they might be able to put a Band-Aid on the problem and kick the can down the road. But unfortunately, it puts them in a position where they're taking much, much, much more risk. Because if you're getting 3% on that 10-year treasury, and now you need to get, let's say, 7 or 8%, well, the only way to do that is go further and further and further out the risk curve. And what a lot of these banks are doing in the Eurodollar system, these globally systemic banks, which absolutely impact the regional banks in the United States, is they're buying derivatives. More specifically, they're buying CLOs, which ironically enough, a lot of those CLOs that these Japanese banks are buying are backed with what? Commercial real estate in the United States. So it's all this interconnected system where if you don't understand how it's connected, then you just look at it on a case-by-case basis. You just look at it as though this is just a commercial real estate problem, or you look at this as it's just a problem with Silicon Valley Bank, Signature, and First Republic. But it's not. It's a problem quite literally with the entire monetary system, because the entire monetary system is built upon collateral. So if you remove that collateral, just like we removed the collateral, which was mortgage-backed securities back in 2008, the system can't function, and the house of cards starts to crumble. And then the real providers of liquidity, not the Federal Reserve, not the central banks, as you know, Kenny, it's the commercial banks themselves. So if they start to see the house of cards crumbling, then that means counterparty risk increases. If counterparty risk increases, liquidity completely dries up because they don't want to take that risk, and that just exacerbates the problem. So the next question is, okay, George, well, how do I know that liquidity is drying up in the global monetary system? Which, again, will definitely impact the regional banks in the United States. It'll impact the major banks, and it will impact the U.S. economy. Because, again, this system is so interconnected. It's actually quite easy. What you have to do is you have to look at the risk-free rate. You have to look at the 10-year treasury yield. You have to look at the inversion of the yield curve, and that will tell you all the information you need to know. Because if that long end of the curve is a lot lower than short-term interest rates, what that is telling you is that financial institutions globally are preferring safety and liquidity to risk. So instead of going out there and lending to a Kenny McElroy, let's say, they're like, we don't even want to go there because we are too concerned about all this counterparty risk that we see exploding, even if it's with these regional banks or banks in Japan. And therefore, instead of lending to Kenny, we're just going to buy the 10-year treasury. We're just going to buy something that's safe and liquid. That creates more demand for the long end of the curve. And as there's more demand for the long end of the curve and the Fed increases rates, that's when you get the inversion of the curve, which again, that price signal is telling you that the amount of risk that is perceived in the global monetary system is increasing. And that's exactly what we're seeing right now, or we were seeing. But what's fascinating today, Kenny, is we're actually seeing that curve uninvert. And I'll hand it off to you, but I can explain that further later in the interview if you want me to.
Yeah, I do, for sure. I want to just explain to everybody that without a doubt, commercial real estate has been repriced. That is a fact. It's been repriced because interest rates have gone up and the cost to borrow has gone up, and therefore cap rates, capitalization rates have gone up. So across the board, commercial real estate is probably 20 to 30%, in some cases more, devalued from where they were 2 years ago. The real issue, of course, becomes if you have a loan mature, if the equity wants their money back. So, that's if it's realized. And so, in 08, George, you remember we called it extend and pretend. And so what's happening is these banks are they're trying to work with the borrowers, and they're saying, okay, how do we kick this can down the road? So, but what I was going to ask you is, what stage of the pain do you believe that we're in?
Well, I think we're in the middle innings right now. I think this all started in March of 2023, and there's no way we've seen inning 9. And let me show you a chart here that's going to give you a great visual representation of what I'm referring to, Kenny. And for this one, I hope you're sitting down. I think you are. I know you got a standing desk. I think you're actually sitting down. Your viewers should be sitting down because, like I say on my videos, it's definitely stiff drink time. So if we can go over, and I did a screen share. Can you let me know if you can see this chart?
Yep.
Okay, fantastic. So these are the unrealized gains or losses for the commercial banks in the United States, and this is per the FDIC. Now, you see 0 way at the top, unfortunately, and this goes down to negative 700 billion. Now, I want you to notice where we are now, Kenny. You see that?
Yep.
That's a lot of red, my friends.
Yep.
And you say, well, George, maybe that's not that big of a deal. I mean, it's only 700 billion worth of unrealized losses on banks' balance sheets in the United States. Okay, but let's go ahead and compare that to the GFC. And you can see 2008 here on the chart, Kenny. I'm assuming you can.
Yes.
The maximum amount of unrealized losses we had on banks' balance sheets in 2008 during the GFC was about 75 billion. 75 billion. Now, almost 700 billion. So this shows you beyond a shadow of a doubt how precarious not just the US banking system is, but the entire global monetary system. Because remember, all the monetary system is an interconnected network of banks' balance sheets, to where if you have 2 or 3 of these very systemically important banks go down, they'll take down the whole system. Very similar to long-term capital management back in the late 90s. You know, a visualization that I used on one of my recent videos that I think was very impactful, Kenny. You ever watch the Tour de France or one of these bike races?
Yeah, of course.
Okay. So the way the banking system was, let's say back in the 1800s, it was basically like these guys are all spread out. You know, the guys at the front, how they're all kind of spread out and they're in a line. And if one guy, let's say, gets a flat tire and hits the curb and falls, well, it really just impacts him because the guys have plenty of distance between one another. But then what happens is we fast forward to the 1950s, the 1960s, once we start the Eurodollar system, and these banks start to depend on one another for that liquidity, because at the end of the day, they're the ones that are in control of the monetary system because they are lending money into existence, even dollars. It's not the Fed that's doing that, not the Fed that's responsible for that, commercial banks. So in the 1950s, 1960s, now all of a sudden you had a bike race where they're not really that spread out, where they're more compact. And therefore, if you have one guy crash, let's say you've got a race with 200 people and they're spread out like this. Let's say one guy at the front falls down and he takes out like 5% of the people in the race. So he takes out like another 10 people, let's say. Okay, well, that's bad, but it's not catastrophic. Now our system is so tight, using that analogy, there is so little space between each bicycle that if one bike goes down, it's like those horrific crashes that you see in the Tour de France, where it takes out the entire, I think they call it a peloton. It takes out the entire group. Like every single bite goes down. And that's the way the banking system and the monetary system is set up right now. So I would strongly encourage your viewers to look at it through that lens. You can't just sit there and say, well, that was Silicon Valley Bank. That's an isolated instance. It doesn't work that way, especially when you've got this level of unrealized losses on banks' balance sheets. Now, to be clear, if they are able to hold these to maturity, then they don't have a problem. But if you have a little hiccup, such as credit risk, such as a lack of liquidity, such as deposit flight, such as your funding costs going up, it's going to put that bank and the system in a position where those unrealized losses become realized losses. And that's usually the straw that breaks the camel's back.
Yep. Yeah, for sure. So let's take a look at the graphic, the real estate exposure of the largest U.S. banks. If we could click on that real quick. I think this is an important graphic for everyone to take a look at. And really what I would want you to focus on would be the red pie piece. So it's easy to see, obviously, JP Morgan right in the middle, but you can see that they've got 12.6% exposure. Now, this was at the end of last year. But it's pretty accurate even still today. But the ones at the bottom are the ones that are really, really in trouble. As you can see, the New York Community Bank, over 57% of their assets are exposed to commercial real estate. Then you got you got Huntington and M&T Bank. And so you got to take a look at not only the dollar figure, but you got to take a look at their total exposure. And obviously, what they've done is they've moved their credit rating on New York Community Bank to junk status. And the reason why this is important is because, I looked these up. The New York Bank has 400 branches. Huntington Bank has 1,000 branches. M&T Bank has 1,000 branches, has 18,000 employees. And so you're going to start to see the cracks come as the office buildings, the retail, the multifamily, as some of these loans start to mature, you're going to start to see it's going to affect some of these banks. And to your point, George, as we start to see bank closures, this is all going to move through the system. And I agree. I think we're at the, in the maybe the first 3 or 4 innings of a 9-inning game here, because what's happening is the borrowers are trying not to ruin their own credit and lose the assets. The properties are maturing, and so the banks are trying to work with the borrowers if they can. But a lot of these loans are way more than the value of the property. So this is going to work its way through, as you like to say, the pig through the python. It's going to work its way through, and it's going to affect the shareholders, right?
Yeah. And can you throw up that?
Yeah.
Yes. Okay. So I know I'm pointing at it here and you can't really see what I'm pointing at, guys. But what I want you to do for the audience is there's a bank right under JP Morgan called Truist.
Truist. Yep.
Truist Bank. Okay. What we have to realize, the assets of Truist Bank, not all of them, but a lot of them, a significant portion that you don't see on this chart, are the liabilities of PNC. And the assets of PNC are the liabilities of US Bank Corp.
Yep.
You see where I'm going with this, guys?
Oh, it's all connected.
It's all connected because if you look at these banks' balance sheets, you see that they have extended loans to the other banks. This is the liquidity that I'm talking about, because these banks can create dollars out of thin air. They just lend them into existence. It's called credit, right? So each one of these banks has the assets of another bank on its balance sheet. And therefore, those assets are a liability of another bank. And then a bank, let's say Wells Fargo, its assets are a liability of, let's say, PNC. So if that's why you have this systemic risk, that's why if one of these guys goes down, especially if it's the wrong one, based on how they've set up their balance sheet, it can have a huge negative impact on several other banks, if not the entire system. And at the very least, let's just say one of these banks goes bust. At the very least, the risk, the counterparty risk within this system increases. Because if your buddy that's a banker just goes bust, how willing are you going to be to lend to your other buddy who's also a banker that has commercial real estate on their balance sheet, or has even if they don't? You're going to be like, whoa, no, time out. I'm gonna take risk off. I know I love you, Kenny, or my banker buddy. We've been doing business for 25 years, but right now I cannot afford to take this risk because I don't know how this is going to play out, and therefore I'm just going to buy that 10-year treasury, which there puts that banker in a precarious position because they've been depending on that other bank for their liquidity for the last 25 years. And once you start to see things through that lens, you see the fragility of this entire system.
Right. And I think it's important to understand, like if you look at the New York Community Bank, that's Flagler Bank. So a lot of times these are holding companies. And so George is right. A lot of these things are lending to each other, and this whole system is interconnected. But the one thing I really want to make everybody understand is whether this is an office building loan or a multifamily building loan or whatever it is, it's going to be based on whatever they've lent on. So it could be different markets, it could be, whatever. But as that hits the banks, what's going to happen is they're going to pull back just like they did in 08. So what does that mean? That means they're going to pull back on residential loans. That means they're going to pull back on lines of credit. That means they're going to pull back on automobile loans and all that stuff. The bank is, this is one piece, yes, but it's not just one piece to the bank. It affects it's just like you guys. If you had one source of your income personally that gets hit, you're going to pull back and look at the whole picture. Yeah. And so that's actually what's happening next is you're going to have a credit expansion or a
credit contraction.
And credit contraction. Right.
Yeah, that's absolutely right. I couldn't agree more. And this, although is something we need to be cognizant of, it's also going to create potentially a once in a lifetime opportunity for those people who are prepared. So what if it's okay with you, Kenny, why don't we just go over to the yield curve quickly? Yeah. I can show people how this is playing out within, or how this is being expressed through prices and yields within the yield curve. This exact same phenomenon that we're explaining right now, you can see it playing out in the yield curve. You don't have to take George's word on it. You don't have to take Kenny's word on it. The bond market is telling you everything that you need to know right now. But then I think we can, and you would probably have a better read on this than I would, because you're neck deep in this and you're seeing opportunities starting to spring up right now. And I think those opportunities are going to become even greater in the next year or two for those people who are prepared. So let me go over to the 2s and the 30s. When most of your audience, if they know about the yield curve, I'm sure they hear about the 2s and 10s. So what you're doing is you're looking at the 2-year interest rate relative to the 10-year interest rate. And as you can imagine, we should see a steep yield curve. So as the maturity gets longer, the yield should increase because theoretically there's a lot more risk. Just like if you're lending to someone for 1 month, you might charge them 1%. But if you lend them for 30 years, you're likely going to charge a much, much higher interest rate because you've got credit risk, you've got interest rate risk, you've got inflation risk, you've got all these things. But so when it is inverted, when it's the opposite, where the short-term rates are actually, when the short-term rates are actually higher than the long-term rates, that tells you that something in the system is fundamentally unsound. That should not happen. That tells you something is going on beneath the surface that is a huge red flag. So and we've had an inversion of the curve for the last 2 years. But what's fascinating is just today, Kenny, is either today or yesterday, we saw the 2-year and the 30-year uninvert. So let me show you what I'm referring to. Can you see the 2-year treasury yield?
Yeah. So what does that mean, George? Like when you see it uninvert?
Well, so for the last 2 years, the 2-year Treasury yield has been higher than the 10-year and the 30-year. And so that's when you have that warning sign that, hey, something is really, really wrong, because this is a reflection of the banks taking risk off the table. And when they take risk off the table, what do? They buy treasuries, which brings down the yield, okay, especially the long end of the curve. But today, or just yesterday, we see that the 10-year Treasury is, or excuse me, 30-year Treasury is now trading at 4.45, which means it is steepened out. So obviously very flat, but the 2-year Treasury yield has gone under the 30-year. Now you say, George, that's great news, because now the curve is no longer inverted. Unfortunately, that's historically when we'll call it the stuff hits the fan. The stuff, a hard landing, recession, whatever you want to call it, spike in unemployment, that rarely ever happens while the curve is inverted. Going back to the 1950s, 95% of the time, we get the hard landing after the curve no longer inverts. But what's interesting is how the curve has uninverted. Let me go over to a diagram, and I'll give a huge shout out to my buddy Macro Alf. He runs the Macro Compass, I believe. And this is his chart that someone sent me on Twitter today. So there's two ways that a curve can uninvert, if you think about it. So you got the short-term rates up here, the long-term rates down here. So you can have an uninversion by the long-term rates going up, or you can have an uninversion by the short-term rates going down. And they're much, 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 much different. Because if you have a bear steepener, what we call it, where the long-term interest rates go up, that's actually a healthy sign. Because now all of a sudden, those banks and the financial institutions are starting to take on risk, therefore they don't need those treasuries anymore. But what happens is if you have a bull steepener where the front end of the curve goes down and the long end of the curve goes down slightly with it, that's the sign that they're not just taking risk off the table, that they are incredibly, incredibly risk averse. And that's usually when you see the Fed start to drop rates. And that's usually what completely uninverts the curve. And right now, I think the 2-year Treasury yield is just giving us an indication of what the Fed is going to be doing very, very soon. Not because they want to, but because they have to. And so here's a diagram of the two steepeners, Kenny. You can see the bear steepener. I don't know if hopefully you can see my arrow. That would be a result of the long end of the curve going up, the 10-year, 30-year, going up at a much faster rate than the front end of the curve. That's the good one. That's what we would want if the economy was becoming more healthy, or we are going back into the next cycle of economic growth. The bad one is the bull steepener, where the long end of the curve goes down slightly, but the front end of the curve, in this case, the 2-year compared to the 30-year, goes down at a much faster rate. Now, what we're going to want to wait and see is when this happens to the entire curve, because the 2-year is still higher than the 10-year. But usually these things just happen one at a time. It never happens just boom, all of a sudden the entire curve is now steepened out, unless you have an instance like COVID, where the Fed just immediately drops rates all the way down to zero in one foul swoop. So to reiterate, we see a bull steepener right now as we speak with the 2-year, 30-year yield. And if you go back, I might actually have that chart up here, Kenny. That would be interesting. Here we go. I've got a 10-year, 3-month, which obviously isn't the 2s and 10s, but it gives you an idea of the concept that I'm referring to. And each one of these gray lines is a recession. So you can see that every single time we have a recession, it is preceded by an inversion of the curve, but it is also preceded by an uninversion. And I would like to point out to your audience that every single one of these uninversions that happened, where we had the stuff hit the fan, within 6 months or a year later, it was a bull steepener. Not one time was it a bear steepener. And that bull steepener is what we're seeing play out right now with the 2s and the 30s. And I think my base case is the probability it's very high that it plays out with the 10-year and the 2-year as well.
Yeah, that's really very interesting, George. It looks to me like, based on that chart, that we could be rolling right into a recession. if we're not already in one.
You see a lot of very powerful economic indicators pointing to that. And it's not just George Gammon saying this. It's even if you look at the Fed's indicators, such as the near-term forward spread. If you look at the full-time unemployment rate, that has dipped down to a level that you only see when you're in or very close to a recession. People in the mainstream media have been talking about the SAHM rule, SAHM. And this was devised by a gal, Claudia Sahm, I believe her name is, who used to work at the Fed. And she went all the way back to the 1950s. And she saw that if you take like a 3-month moving average of the unemployment rate, and if there's a delta of over 0.5% from its trailing 12-month low, every single time you are either in a recession or you're right on the doorstep. And we are just that close to the SAHM rule being triggered as a result of the unemployment rate a couple weeks ago going up to 4.1%. And I could go on and on and on about these economic indicators. There are no certainties, Kenny. I want to be very, very clear. There are no certainties. We're in a game of considering probabilities. And it's just the probabilities right now are high that we go into recession. Now, does that mean an economic crisis, a GFC? No, we could avoid that. It could be a garden variety recession, similar to what we saw, let's say, .com or the early 90s. That's definitely possible. But it's understanding all the facts, reading the data, reading the price signals from the bond market, and then coming to your own conclusions on what you think the odds are. What it's not about is burying your head in the sand like an ostrich and just pretending that none of this exists and that everything's going to be fine and dandy. All you have to do is just keep dumping money into your 401k. That's just whistling past the graveyard.
Yeah, I wanted to chat with you about, like, I feel like these rates are just a smokescreen, the cut, because it's not going to affect meaningfully the real estate market much. It's a, quarter point here, quarter point there. It's not meaningful because the rates went up so fast that people are severely underwater. The majority of the U.S. is sitting in 4% or less interest rate fixed. And a lot of these deals in the commercial market, we're all set around there too. We're 6, 7, 8%, even 9% for construction money. So, yeah. So everybody's like talking about rates as if like it's going to save the day. No matter what's going on with our CPI, whether you believe it or not, the reality is a quarter here, quarter there is not going to actually do anything meaningful, right?
So you bring up a great point, Kenny, because the argument, the pushback is, well, George, in the bond market, I understand exactly what you're saying, but this time what could happen is the Fed could drop rates down to, let's just say 4.5% or something like this, gradual rate decline, and that's going to fix the problem. Because Kenny, if what you're saying is that the main issue here, the catalyst, is the Fed increasing interest rates, well, there's a simple solution, right? If they're not worried about inflation anymore, all they have to do is drop the rates back down to, let's say, 3, 2, 4.5, whatever it is, whatever the magic number is, and then it's off to the races again. Okay, the problem with that argument is it's never happened. Never. And I've got a chart up, if you want to switch to that real quick,
yeah,
Kenny.
Let's take a look.
That shows the last few recessions. We can just go back to 1990 like we did before. And, show me the recession where the stuff hit the fan and the Fed was able to drop interest rates by 25 basis points and just leave them there because they engineered a soft landing. It doesn't happen because by the time the Fed responds, and some people use mid-90s as an example, but the entire curve wasn't inverted back then. Completely different situation. So if you look and compare apples to apples, you see that every single time the Fed has to drop rates, like I said earlier, they drop rates because they have to. They have to, because they're responding to a crisis. They never drop rates because they want to, and because inflation just has magically come down to their 2% target, and now they can just drop by 25 basis points every single meeting for the next year and a half. They can stop at whatever the number is, 2.5%, and then all of a sudden the economy comes zooming out of the gates, because that's all it needed. There's just a little bit of a breather on the interest rates. That never, ever, ever, ever happens. And another thing that I'd point out as to a strong reason why this cycle, this time around, is because let's think about this, Kenny. What's the main reason why we have seen residential real estate, which we know how important that is to the economy, and we know how important that is to the banking system? Why has residential real estate gone up so much in price since 2020?
Well, it's interest rates and supply. That's
but let's just leave it at that.
Yeah.
Because what happened is the Fed jacked up rates. People got locked in to a 3% 30-year fixed rate mortgage to the point where they couldn't sell. And therefore, there's no supply in the market. So even if you have a little bit of demand, then that makes prices go up because real estate prices are set at the margin. Well, if that's true, which I don't think any one of your audience members would dispute, well, then how is it possible that if the Fed drops rates, we won't see the opposite?
Right.
You see, if the Fed drops rates, well, now all of a sudden, I'm not locked into this 3% mortgage anymore. I can sell my house. And I've been wanting to sell my house for the last 3 years. Now I've got the opportunity to do it. And oh, by the way, I just lost my job. So I have to sell my house. Even if I wanted to keep it, I can't. And even if that's not the case, the cost of my insurance, maintenance, taxes, the cost of home ownership has gone up to the point where I can't afford it anymore. So I've got to cash out this equity. So you could, I'm not saying you will, but you could see the exact opposite on the way down, which overloads the housing market with supply, which drops prices, which obviously would have a negative impact on aggregate demand.
It's good for the consumer, though, and that's actually the problem. Yeah, I can't disagree, but what's happening now is, the high interest rates are restricting new construction, and it's just simple math. When you have this many people coming into the country, and I'm only going to barely talk about immigration, but immigration creates housing problems, as does births minus deaths, and so you've got this population growth that's happening regardless. And so the economy is doing its thing. But when you raise interest rates, developers pull back, and therefore there's no more supply being added. That's the issue. And so what we have a really high mortgage payment with a low rent right now. But you're going to start to see the rents are going to start to go up over time because why? Supply. We need, even though right now we're being hit with apartments and new construction, that stuff started 2-3 years ago. There's lag with all that stuff, and it's hitting right now. It's creating a little bit of softness for the renters, which is good, but not on the residential side. The people that are trying to buy a home, the affordability for the homeowner, people are supposed to be able to rent, build credit, buy a home. That is the right process. I'm a landlord. I'm supposed to lose renters to homeowners. That's the way it's supposed to be. But right now they're locked, and we're heading into this renter nation status.
Yeah, but that's if they can afford it.
Correct.
I mean, that's where, as real estate investors, which I know a lot of your audience is, you've got to be very, very selective about the markets, because obviously what Kenny is saying is spot on. But in some markets, even though you should have rents increase or stay the same based on the supply dynamics, you're going to have problems with the people being able to even afford a minimum level of rent. And I've got this Wall Street Journal article. Well, that's on the CPI. I had it pulled up on my other computer. I apologize, Kenny. But if your audience wants to look at the Wall Street Journal today, they'll see an article titled, I'm just looking at my other computer here, Evictions Surge in Major Cities in the American Sun Belt. So they focus on Houston, Phoenix, and Las Vegas, and they show the eviction rate now, even compared to 2019, and it's like twice as, it might even be more than that.
And what's important about that, George, I'll tell you what's most important about that is rents are flat. So it's easy to pick on the landlord when rents are going up like that. And they have, don't get me wrong, over the years. But the point is rents are flat right now. So what's really happening is the consumer's getting squeezed with inflation. Their food's gone up, all the other things. And so they're all their discretionary money and their savings, as we know, the savings rate's basically almost nil. So that's actually what's happening.
Yeah, no, I was not trying to blame the landlords at all. No, I was saying that this is indicative of the people just not being able to afford it anymore. Exactly to your point, because inflation has eaten away at their purchasing power. Their wages have not gone up with the rate of inflation. And at a certain point, once you've maxed out your credit card, you've got to rob Peter to pay Paul. And a lot of times that means not paying rent just to put food on the table. And you do that a few months straight, and that's going to lead to an eviction, or which is what we're seeing. But keep in mind, Kenny, we're seeing these levels of evictions with the unemployment rate at 4.1.
Right.
And it is true that it's gone up to an alarming level based on the SOM rule, but still 4.1 is way under the historic norm. I mean, for a recession, usually the unemployment rate goes up to 6, 7, 8, 9%. So think about the purchasing power, or the average Joe and Jane's ability to pay rent, especially in these Sunbelt areas where they're already struggling, if the unemployment rate goes from 4.5 up to, let's just say, 8.
Yeah, well, I think even the Fed themselves said that they believe the stability is somewhere at 4.5 to 5. And so they're still a ways from that. And I don't think people realize what that will do, because that just drives all those things that you just talked about with the evictions even worse.
Well, the Fed doesn't realize it. First and foremost, because they never get it right, Kitty. They always overshoot. They're always behind the curve. They're always reacting to a problem, which is exactly why you see the interest rates drop so dramatically before we get just prior to a recession. But so now let's, if you would, you want to talk about some of the huge opportunities.
Yes, I do.
Because that's really what it's all about. It's not about just, presenting all the negative stuff. And the reason I do that is just to make sure that people's risk management is on point. Because the more I hang out with, super smart guys like yourself, or some of the guys that I'm lucky to hang out with in the hedge fund space, or even reading, some of the books that I have behind me, like the Market Wizards books that I strongly suggest, you realize very, very quickly there's 3 things that go into a good investor. And it's across the board. Number 1, it's good risk management. Number 1, first and foremost. Number 2, you have to place asymmetric bets where your upside is far greater than your downside. And number 3, you have to have an edge. Those are the 3 things you have to, and I don't care if you're investing in real estate, in bonds, in FX, in Bitcoin, and stock. It doesn't matter what you're investing in. Those 3 things you have to have. And you notice I started with proper risk management.
Yeah. So as you know, what I've been struggling with over the last 3 or 4 years is that a lot of people were buying real estate as these prices were going up, but they didn't make sense financially from a cash flow standpoint.
Yeah.
So now, because real estate's been repriced, we are actually going in pretty hard right now. We just put one deal in escrow, 360 units, and we're basically buying it below replacement cost. And we're starting to see, so people need to understand, when this, I did this in 08. When the banks start taking assets back, they're not supposed to own real estate. When people that bought stuff are losing stuff, then the banks now are in trouble, and the banks are not real estate managers. And so it's your job right now to go fix their problem. How do you fix a local bank's problem? How do you restructure these loans and buy these assets at market prices today? And then that's how you make money. That's how we made a lot of money in 08, 9, 10, 11, is we were actually going and fixing problems for Bank of America, La Jolla Bank, a whole bunch of Wells Fargo. So we went in and the banks do not want these assets. They get negative credit ratings. And so the real opportunity right now is to go find these distressed loans and start working with some of these people and acquire those assets.
Everything is a function of price.
Correct,
Kenny. What you're explaining right there reminds me of a story I heard about a famous hedge fund manager. I can't remember who it was. It wasn't like a Big Short guy or something like that, but it was another really famous hedge fund manager that made an absolute killing during the GFC, and he made a killing buying mortgage-backed securities. Because what happened is, when you had Lehman, when you had Bear Stearns, when you had the whole everything that we remember, the price on the mortgage-backed securities went down to such an incredibly low level because everyone thought they were just going to go bust, that it actually made sense from an asymmetric standpoint that we were just talking about. And that was that person's edge. And they made a killing because at the end of the day, and your viewers might not know this, but at the end of the day, only about 6% of the mortgages in the United States went into default. You know, people think that it was like 50 or 60%. No, it was only like 5 or 6. And by the way, it started at only like 2. So that goes back to what we were saying earlier about systemic risk, right, Kenny? If the mortgage, if the default rate on mortgages can go from 2% to 6%, and it can cause a global financial crisis. That's how interconnected the banks are. But my point there is it's all a function of price. And even during turbulent times, if you can find something that's priced at an attractive level that gives you that asymmetry, even though you have to hold your nose to pull the trigger, often those are your best bets.
Well, I know next month we're going to be talking about this at Limitless in Dallas, and I know you got some of your buddies there, like Jeff Snyder, and so obviously for those of you guys might not know, we got Limitless next month. We get together. There's 50 speakers and 3 stages, and we're trying to figure this out. Like things are going to be very different in 6 weeks. George, can you talk a little bit about what you're going to discuss? At Limitless next month. I know a lot can happen in 6 weeks, but as you know, this is the time to be looking for opportunities.
Yeah, absolutely. And it's hard to give insight on what I'm going to be talking about because we're living in times that are just so volatile, Kenny. But I imagine what I'll probably be discussing then will have something to do with the curve being fully uninverted. I'm not going to go out on a limb and say that's my prediction, but I think that would probably be my base case right now, where at least the 2s and 10s have inverted like you normally see right before kind of the stuff hits the fan. So I think what I'll be doing at your event is really trying to discuss how to time these things, right? Because that's another thing that you usually see the stock market rip higher when the curve is actually inverted, which is very counterintuitive. So but it's all about timing. Okay, when should I be invested? When should I be, have my dry powder? And then based on history, how do you time these things, and what do you use to time them? Because there's a lot of very, very powerful indicators that we have at our disposal for people who just educate themselves and just realize that, oh yeah, this is what usually happens. Bam, 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 bam. And if I see this happening, then I know that we're likely to get a recession here, or the unemployment rate is likely to spike here, or X, Y, or Z is supposed to happen. So that's what I'll probably try to focus on more, is how to time the economic contraction, if you want to call it that, and therefore how to position yourself accordingly to take advantage of these opportunities we're talking about. But I know we've got, it's going to be Mike Maloney, Jeff Snyder, obviously Kiyosaki is going to be there, and a ton of your really, really good buddies in the real estate space. So this is going to be an absolutely incredible event that I cannot suggest people attending enough.
Yeah, I know one of the things I keep changing my mind on what I'm going to talk about, but I think what I'm going to discuss now is what markets are the best to invest in, because there are markets right now, George, as you know, that are actually doing just fine. Yeah. And so a lot of times people, when they say, oh, that's not going on, it might be true. They might be sitting in a market that there's no disruption, but there's a lot of markets that are in massive disruption. And, of course, we're looking at that. We have, as you know, we're going to deploy, we're going to buy $1 billion of assets in the next 18 to 24 months. We already have 120 million in equity that we're going to do by the end of this year. And we're very, very, very bullish on where everything's headed. And it's very important that you not just put the money out, that you actually put it out in the right place. And so that's what I'm going to discuss, is where, and what you want to do is you want to buy well, and then you want to make money on your money. It's essentially, I've been doing this for 30 years, and the market is more important than the property. Trust me. So first you start with the market, then you go to the property.
Yeah. But it's all about your process. See, the reason you've made so much money, Kenny, the reason you've been so successful is you've refined your process over 2.5 decades, right? And that's what people really need to understand, because what you're saying right there is that you're bullish on X, Y, and Z. But even if you're not bullish, even if I wasn't bullish on the multifamily space, let's say over the next 10 years, that doesn't mean I wouldn't be buying right now if the right opportunity presented itself. And the way I always say this is, when, let's just say you're bullish on this, you're expecting prices to go up. Okay, great. What you're doing there is you're buying something, you're buying $1 for $1, let's say, because you expect it to increase in value to $2. But what you're doing right now, because you've got so much experience, is you're not buying $1 for $1. You're buying $1 for 50 cents.
Correct. Right.
So even if the market doesn't go up, even if you're bearish, if you because of what we've been talking about, the systemic risk, you're going to be able to buy stuff at pennies on the dollar. And even if it goes up by, let's say, even if it goes from bad to good, it doesn't have to go to great. You're still going to have 2x, 3x your money.
Yep, that's right.
Yeah, you got to remember, if you buy $1 for 10 cents. The prices can double, and there's still only 20 cents, but you've made 100% on your investment.
That's right. That's what we did in 08. We basically bought at 40, 50 cents on the dollar. We're starting to see that again. And of course, we're long-term guys. So we're not hamstrung by maturity, maturity of the loan, because we're fixed long-term, or the equity. And so we can ride the project to the point to we might not time it perfectly, because it's really, really hard to do that. But if you just buy well, it cash flows day one, and then you have your fundamentals guide you. They could be 3, 4, 5, 6, even 7 or 8 years before you start to see the full maturity. But even doesn't really matter, because if it's cash flowing all along and everybody's making money all along, then just like anything else, you're just waiting for that equity to build.
Yeah. Which it will if you buy at the right price. That's
right. Well, George, boy, what a great conversation. Thank you. I can't wait to see you at Limitless. For those of you, there's a code. It's Ken10 if you want a discount. That's on the VIP or on the general admission. We're going to sell out like we have in the last couple of years. There'll be 2,000 people there, 50 speakers, 3 stages. This is not a newbie conference. This is a conference for people trying to figure out what the heck's going to go on. Obviously, we're going to announce a huge guest. I can't announce them right now because I'm in the middle of negotiating with them, but trust me, we already have some great speakers. Just go check it out.
I made the connection. Trust me, it's a huge guest.
Yes, you did. You did. And so I tell you what, George, we're this close. So it's very, very exciting. So we hope to see you guys there. We'll all be there. We'll be able to answer your questions. George, as always, I appreciate your time, man. You're a wealth of knowledge, and we'll talk to you soon.
Thanks for having me on, Kenny.
See you, bud.